we have started doing a lot of physical activities around, especially in the infrastructure sector. Because of Gati Shakti, there's a lot of push from the government, and we've been doing a lot of initiatives with them of late. And the plan is to move everything offline very soon.
Okay.
So we are doing
like
something in
Balaji
Varanasi on 11th and 12th of 11th and 12th of November. We are doing something on Varanasi on PM Gati Shakti with the Inland Waterways Authority.
Yeah,
we did
I know.
You know about that, right? And something we did on cruise tourism with the Mumbai Port Authority in May. A physical event again, against. All right. So good morning, everyone, and a very warm welcome to FICCI's first edition of Real Estate Investment Summit, Building the Next Generation India Real Estate. Ladies and gentlemen, talking on investments, things look a bit gloomy on the face of it. The investors are cautiously observing the intensifying impact of uncertain global geopolitical landscape. The Russia-Ukraine war has only added to the uncertainties. The tightening of monetary conditions globally, increasing interest rates, high inflation rates, leading to dramatic fall of the currency against the US dollar. And not to forget the lingering impact of the pandemic. However, as they say, there's an opportunity in every crisis. There is a silver lining. The investors are the first one. They are the quick to spot one. And ladies and gentlemen, the soft spot here is the Indian real estate sector. The news has it that the asset classes such as office, life sciences, data centers, industrial are already witnessing consistent interest and investment flows. Allocations to residential sector are also showing green shoots on the back of a strong demand from sales in the market. Well, this is what we hear from the news, but it's going to be interesting to hear it from our distinguished panelists during a first panel discussion, which is real estate investments in India, the rising asset classes. Before I go ahead with introducing our panelists, I will take a couple of minutes to unveil the FICCI Westian Knowledge Report, Institutional Investments in Indian Real Estate and the Rising Asset Class. Request IT to please bring the report on screen. The report is an overview for real estate investments in the country and various segments to look out for in the forthcoming period. It also reasons out institutional investments in real estate are expected to emerge stronger going forward. We will be sharing the link of the report in the chat box and also can be downloaded from our website for our delegates. So as we speak, there are 200 plus delegates who have joined us virtually to hear out speakers. Thank you very much, IT. Moving forward, let me bring on board our esteemed speakers to discuss the session forward. Mr. Dutt is joining us in a bit. Mr. Dutt is Joint Chairman, FICCI Real Estate Committee and also Managing Director and Chief Executive of Tata Realty. He is in a board meeting and will join us in a couple of minutes. We have with us
Mr. I'm here.
Yeah. Oh, you're there. Okay. I couldn't see you. So welcome, Mr. Dutt. We also have Mr. Balaji Rao, Managing Partner, Axis AMC Real Estate. Mr. Gauri Shankar Nagabhushanam, CEO, India Business Parks, Capital Investment. Mr. Vipul Rungta has fallen unwell and we will miss him here, but we will definitely convey the proceedings of this meeting to him. This session will be moderated by Mr. Srinivas Rao, who has been very regular with FICCI and works with us very closely. Mr. Rao is the CEO of Westian. With this, I request Mr. Rao to take over the session and ably guide the panelists to bring the best knowledge forward from them by articulating a session. Mr. Srinivas Rao, over to you.
Thanks, Neeraja. I think we have the best of the industry here. Sanjay, Balaji, Gauri. I think these guys bring in enormous amount of years of experience, and both from a private equity perspective, investment perspective, and also as developers, one of the largest developers in the country. One of the key points that I wanted to bring out during this session was also about the fact that the business environment has been impacted over the last few years thanks to the pandemic. inflation pressures have been there, and of course the economic constraints of the global issues that we are facing today. However, the silver lining in all of this has been Indian real estate, from a perspective that between January of 2018 to September of 2022, we have seen about $27.8 billion of investment coming into the Indian real estate. Out of this, 13.4 billion came in the last, I would say, 20 months. And over the last 9 months, we have seen about 9 billion coming into the Indian RE industry. Sector-wise, if you look at it, 60% of this came for the commercial/retail industry. 28% came in for the residential sector, and this was just 4% in 2020. And now you see a resurgence of the Indian residential sector. All of these mean that there is a silver lining. All of this means that the investment market is opening up for institutionalized investors. Having said that, my first question to Sanjay: tough times, COVID, pandemic, all of these issues. Have we come out of the situation, and what do you think? Where do you think India stands in terms of the institutional investment in the country's real estate sector? And are we getting enough capital, or should there be more? What's your take on that, Sanjay?
Thank you, Shani. It's a pleasure. I think given the current environment globally, and Nirja very well captured it in the beginning, there is a pause currently. But there's a pause knowing that how next 3 or 4 months things will evolve, and perhaps there'll be return to investments. If you go back in history, whenever we've seen the volatility, it only provided more opportunities. So during the COVID period, the 2 of the largest real estate developers in Bangalore sold their portfolio to private equity. So it was close to a $5 billion deal between the 2. So investors who are long-term committed investors to India know that the fundamentals are strong, and the downturn and the volatility gives them the opportunity to actually seize the moment and dive in and acquire opportunities which otherwise they would have not got, if you ask me. I see situation like that evolving at all times. We will still see it close to 40 million square feet of absorption calendar year, Jan-December this year, which is incredible, barring few cancellation of the RFPs in the last quarter till December because of current situation. The bounce come April 23 will be very strong. And what has changed between earlier and now is that the supply is extremely limited, and rentals are firming. And also access to capital is also constrained. Not everybody can access capital in today's market as they did so in the past. So speculative developments, barring Hyderabad, Gachibowli, and outer periphery of the high-tech city area where you have excess supply, most other places we don't. So I think my view is the investors are keenly looking at it, but they're underwriting the assumptions on a conservative basis with the hope that they will be able to exceed those returns that they're promising today.
Interesting. Balaji, what do you think has changed since the time the pandemic has stuck, and from a private equity perspective? Has the views completely changed, or is there something else that people are thinking about? And is it word of caution right now? What's your take on this?
Thanks, Srini. But the way I look at it is, since the pandemic, if anything, I think Indian real estate has come out with flying colors. Because yes, there has been a pause. Yes, we have been fighting stagnation. But we have also showed a lot of resilience, whether it is in the residential, whether it is in the commercial. We have shown resilience to bounce back. And that bounce back has been very quick and rapid. So during the pandemic, initially the healthcare, the pharma, the IT, the e-commerce gained. But I think in the long run, it will be real estate that will gain the maximum, because what it has shown is the importance of a physical dwelling. A man's castle is always his home. And that has really proven the point to everyone that you cannot really just completely live in a virtual world and in a digital entertainment space and forget about whether you have to put some investment into real estate, whether it is just for staying purposes or for renting purposes. So I think that has come home, and I do believe the way we have bounced back gives us a lot of confidence, even to an investor, that this is a story to stay. And it shows, it has brought us back into the limelight to show that in any asset allocation for any sort of a wealth manager or an ultra HNI, physical assets will be a cornerstone. It cannot be just ignored. However, the new dimension that has started is, and that had started even pre-COVID actually, is the financialization of real estate. I'm a big evangelist of financialization of real estate. Naturally, I have a bias towards it, but I do believe investors can participate in physical asset investments without having to only buy physical assets, but come in via various methods, whether it is a REIT or a AIF or an IPO or public equity. And that is the way the democratization of investment in real estate will start. That means there will be millions of people who can come in and participate, even in commercial property sort of a investment, without having to say that I have to cut a big check, to do it. So I do believe that age is dawning, and it is dawning fast. And more people are looking at this avenue as a sort of a counterweight, a counterbalance to the otherwise highly volatile world of equities and debt. So I'm not saying everybody has to put everything into real estate, but I feel a sizable investment should always be linked to physical and real assets as a counterweight to the otherwise seductively allurement of your equities and debt, which makes people believe that, you should put everything into that because it gives you better returns. I do not believe that. I believe real estate has shown that it can give steady returns. It has a longer period of waiting, but that helps you. And being illiquid, it actually helps you, I tell people, because it doesn't make it volatile, because volatility creates not only opportunity, but also it creates its own crisis. So if you are in an illiquid asset, sometimes it's much better off. And as an aside, I can tell you, like when you look at the royal families of India, the royal families which lost their privy purse during the late 60s, the ones who didn't have any fight, they sold off their palaces, turned it into hotels, and somehow tried to survive. But the families which had lots of fights, like say the Scindias or the Maharaja of Baroda, and their properties got completely gridlocked into litigation, 20, 30 years later, they're reaping the benefits because it's really huge billion-dollar properties. So being illiquid has its own charm. Otherwise, when it is totally liquid and mark to market, you tend to keep on fiddling with it, going in and out. Whereas if it is illiquid and you think you have a horizon of 8, 10 years, everybody makes money in real estate. And this is a world over phenomenon. And that is the real truth of the issue. Sorry.
So you're saying take a long-term view on the real estate. That's what private equity is doing today, taking a long-term view on India.
Private equity is about taking a longer-term view. Institutional investment is about taking a longer-term view, so that, yes, you can have a certain liquidity like REITs will give it by making public listed. But technically, the institutional investment by itself should be of a longer-term view.
Thanks, Balaji. That was an interesting insight. That it's good to have fights in the family and 30 years later make a lot of money of it. Gauri, over to you. We hear this buzzword that's of co-working all over, right? I mean, it is out of the 55 million square feet of absorption, from a mere 10%, I think it's now going to 18 to 19% of the overall space take up. What's your view on that? And do you think investments would also go into that sector? What's your take on that?
Srini, I'd just like to come in for a minute for all the panelists. We have got an overwhelming response, and as we speak, we have close to 400 delegates who have logged in to hear you.
Thank you. Good to know. Thank you.
Good to know.
Please, carry on.
Thank you for the question, Srini, and thanks to FICCI for inviting me, and hello to all the co-panelists that are there. So interesting question. I think co-working has been the flavor of the day, at least in the asset classes, within the real estate asset class, particularly in India. I'm still to put my finger on the co-working phenomenon. Yeah, it does provide a lot of utility. I definitely personally see it more as a amenity to begin with, because it enables you to capture a lot of value for your own business parks, and it is an amenity which many of the tenants seek out, because in the current scenario, they don't want to lock in long-term rentals on real estate. So having a co-working player right next to their office, it gives them the option to scale up and scale down as their demand, because they're also pitching to typically we are all talking about IT services and ITs and financial services, where they have a client whom they pitch business to, and if they win the account, they need quick space take up. So co-working addresses that part of the equation quite well. And therefore, it has been there's been a lot of I would say positivity around that, and a lot of take up has happened, and a lot of marquee tenants, the Microsofts, the Googles, the ones that sort of lead the path, have signed up large spaces across different cities in India. But it also begs the question in terms of how is the risk getting diversified? Like, who is bearing the risk? I know it's like energy, right? I mean, the universe, they say energy can't be destroyed; it can only be transferred from one format to the other. Similarly, the risk cannot be destroyed. So when you're going from long-term tenancy, which is what commercial real estate is all about. And why do institutions like commercial real estate? Because it has traditionally been like Balaji was saying, fill it, shut it, forget it. The Hero Honda ad. Come back after 10 years, 15 years, you would have had a current income during those 10, 15, 20 years, and then hopefully the economy has really done well and the capital values is appreciated. So that has been the crux around which commercial real estate actually evolved. Even residential, which in India it's still not a securitized product, it's still an individual product, but in the West, if you see multifamily and all, and securitized product, that's the flavor, because they sign 30-year mortgages, so you have a constant cash flows of that you can underwrite. Where is that getting when you're taking that 10-year lock-in period, 10-year cash flows, and you're now converting into something which is like a 1 year, 6 months, and a 3 month, who is bearing that risk is the key question that crops up in my mind. So it augurs well for private equity players that look at valuation gains, because they're able to it's a very nimble entity that can address the requirements, because it is all bespoke. Each and every floor that is going to be given to a tenant is going to be bespoke. They need to address all their requirements and all. So a very, very fleet-footed team can manage that, and therefore there is a value proposition, therefore there is a valuation gain. But institutions which are traditionally into commercial real estate, who look at long-term capital lock-ins and long-term cash flows, how much can they underwrite is always a big question I've had in mind. And I would see the market evolve to somewhere in between. And I'm sure Sanjay and Balaji will agree that even if you look at as developers, if we are to offer co-working space and managed office space, more particularly managed office, the numbers don't stack up in terms of IRRs and return on investments and all. But somehow you have the startups who are able to deliver the same, and hopefully they are making revenue. And in some cases it is a little bit of financial jugglery. Whereas we would, Sanjay and I would sort of write down our capex in terms of fit outs, over a 4-year, 5-year. I mean, after 5 years, we just throw it off. Maybe a
Correct.
6-year term. But if I believe that some of them, that's a positive return on investment, do it over a 15-year period for a fit out, no depreciation or a fit. I'm like, okay, yeah, you can do it, but it doesn't make sense.
Agree. Balaji, your view on this. I mean, you as an institutional investor, would you be, would you be gung-ho about investing in the managed office players? I mean, because that's another rising asset class right now. 18% of the stock is being absorbed by those guys. So would you be investing in managed office players in India?
Yeah, it's an interesting question. The way I look at real estate, what it has evolved, some of the various things it has evolved in besides the corporatization, digitization, financialization, is the whole concept of service real estate. That means real estate previously never used to be a service sort of a concept. And today, suddenly, whether it's in the residential space you live, see student housing, co-living, assisted, in India at least, they have started making inroads into it. And similarly, on the commercial side, you have the co-working spaces. So do we as an investor invest in it? Yes, we can. And we are looking at it very seriously, because I don't think it is a bad idea. But as Gauri Shankar rightly put it, you have to recalibrate your expectations out of this, because now you're investing into a sort of an operating business rather than into a sheer real estate which will give you an yield. So it's not a long-term yield locked in with a 4 or 5% appreciation every year, but it is a sort of an operating business, whether it is serviced offices or co-working spaces, or whether it is even, as I told you, student housing, assisted living, because these are operating businesses. And in the future, I do believe most of real estate will shift towards it. Because if you look at the psyche of the millennial or the Gen Z and all of them, what we call, they do not want to own real estate. They want to only experience the best of real estate. So when you want to have that sort of a culture, then you have to really think that there has to be an owner of the real estate who is being able to operate and manage that business. And then you're taking a bet, not just on the real estate location, but also on the operating capability of that manager, and you are then investing in it. So yes, we are looking at it. And I think it will be the new growth area for investments.
Very interesting. I mean, I always thought that was a risky proposition to put money in because I completely agree with Gauri that every time I've looked at a managed office model, I've never understood how they make money. I mean, till date, I've not figured out how they make money, but good luck to them. Sanjay, this one is for you. The residential market is an upswing. Everybody's talking about affordable real estate. Do you think there's going to be a lot of, will it be lucrative actually? My question is, will it be lucrative for institutional players to get into that segment in a big way?
It is lucrative, and international investors are getting into it. In fact, they're more keen today than ever, because commercial took a little bit of setback. And even though it is strong in India, it will bounce back like we discussed already. But residential is clearly on the upswing. And the reason for that is, one, the consolidation has happened. Second, for the first time in the history, we've seen lenders differentiating lending capital to grade A developers versus to B and C. There's a differential treatment, which earlier was somewhat not the case. The compliance, regulatory control, transparency has come in. Understanding of which market and which product and which buyer profile is much better. Also, segmentation of premium, luxury, mid, affordable is much better spread. Thanks to the government, last 5 years, we've learned what affordable really is. Mostly in Bombay, we thought reducing carpet area is affordable, but in the rest of the country, it can be affordable. So I think there is an opportunity for institutional investors to take advantage. And because of consolidation, there are very few select who can give you scale in this business. And I think that's the opportunity that most institutional investors are looking to seize right now.
So, Gauri, this one, I was just thinking about REIT. India is expected to release its first retail asset REIT soon. A whole bunch of players coming into the shopping malls. Will this be a game changer for the sector? I mean, you guys are already in that business. So what's your take on that from a REIT and retail perspective?
No, I think retail has been one of those property asset class which has really come back with a bang. I mean, I get to hear that rentals have more than doubled, and sales volumes have more than doubled in really well placed retail malls. And this is not just a India phenomena; it is a global phenomena. And this I don't buy into this whole work from home concept. It is either work from an office or you work from a restaurant or a pub or a retail mall. There's nothing like a work from hardly. I mean, bunch of people don't end up working from home, but yeah, they take their calls from one of these joints. So REIT has been a game changer. I think India, I would say, was pretty late in the game in terms of the REIT market. It gives, like Balaji was talking a few minutes back. It really allows democratization of owning real estate assets. There was a time when it was very either you own a residential unit in a long-term mortgage and lock yourself in debt, or you buy a small piece of land somewhere, or not. You couldn't get exposure to quality real estate. On the commercial side, it did change. When the first REIT got listed, a few years back. I think this is just an extension of that. And today, domestically, if you go, I think a lot of players, even during, if you look at the bloodbath that have happened in the markets, India has it has not been a bloodbath, but yeah, the valuations did tank quite a bit. The REITs have held their own by and large, which is actually a true reflection of what a REIT is. A REIT is to be valued based on what the long-term yields and what the reversion to rents are going to be. And so it is a mature market. It showed that the worry always was I had like 5 years back was, would REIT be treated like a regular equity product? People start trading, it start fluctuating. The volatility of a REIT, especially after that first 2 years where people are trying to understand how the dividends are going to be, and what the timelines are they going to distribute and all that. After that sort of settled down, now I think over the last 12, 18 months, you would see the REITs have actually, the volatility has been much, much lower than what the other markets have been. So to that extent, I think the retail mall listing is welcome. I'm sure we'll have probably another 24 to 36 months. You'll probably have a dozen REITs in there to choose from. And of course you'll have, once there are so many REITs, you'll have the good performers and the bad performers, and that's how the industry matures in itself. So I think it's a welcome sign. So retail, I would definitely have a thumbs up, especially for those REITs that have assets in very, very well located places, and who have a quite wide spread of tenant base. It is the operator is the most important part in a retail REIT. It is because unlike a commercial asset, where there's a lot of stickiness, and therefore a lot of drive for demand here. You need to actually keep reinventing yourself every 3 to 6 months. So the best operators will get the best valuation in the retail mall REIT, is my sense.
So the concept of fill it, shut it, forget it, which you said for the commercial real estate, won't work for the retail.
It'll be difficult. For a few, it'll be like that, but for a majority, it may not be like that.
I have a line replacing what very rightly Gauri said. It's fill it, operate it, and engage it now.
I like that one, Sanjay. Fill it, operate it, and engage it. Okay, good one. Balaji, this one, I was just thinking, right? I mean, with so much of talk about private equity coming into the Indian real estate, how important is it for the developer to partner with the right pedigree PE player? Is it a very important element overall from an asset class perspective? Does that rise the value, or is it just, I'm bringing in the money, it doesn't matter where it comes from? What's your take on that?
It's very important. See, if you look at how PE investments came into India, the first wave, which came from 2005 onwards, in that first 5, 6 years, 7 years, they really got beaten up. Because I think in India, what we really lacked at that time was the spirit of partnership. So typically, many developers would tell a PE investor, if this project makes money, I treat you as a debt sort of a person and give you a fixed return. Be happy, your money has come back with some sort of a single-digit return. And if the project tanks, unfortunately, then yes, you were an equity holder with me. So, how do you expect me to do any sort of a guaranteeing on this or assurance of the return? So basically, in my opinion, the spirit of partnership, if it is there between the developer and the PE player, because he is providing the capital, he is dependent upon the developer as an operator to see him through the vagaries and of the cycle. So I would tend to believe that is slowly growing in India. And the second wave of PE investments, which came in, especially in the residential segment via structured debt, I think the spirit of partnership started growing. And now I feel in the third wave, which will come about, where we are seeing more platform deals, then I think it will be even further strengthened. Because I think developers are realizing that this is like two sides of a coin. A developer requires capital, and the capital requires an investment opportunity. So they both have to figure out how to live and grow in that sort of a module, especially in a country like India, where enforceability of contracts is still in a gray area. See, one of the reasons why we don't attract as much FDI as we should be attracting is because foreign investors are always a bit wary about a judicial process. They know that once they're dragged into the courts, it can take years for them to unwind and come out of it. And they're loath to do so. No investor would like to do that, because behind him, all the people who have given him money, they don't want to see themselves landing up in court. So the enforceability of contracts, though, is becoming better over the years, thanks to all these, fast track methods of doing it, NCLT, IBC and everything. But still, we have a long way to go. And I think we do realize that if you have the right partner, you'll come out of it. And if you don't have the right partner, then yes, there are going to be hurdles. So coming back to even this service real estate, what Gauri and Sanjay were talking about, was the question is, it becomes more complex. That means today you just have a developer or somebody who owns the property. Tomorrow you also have to depend upon an operator who is running the business in that property. So it becomes more variables. So as it becomes more complex, then what happens on the PE person is the fund manager competent enough to take care of all those complexities, because he is also having to pick up the right developer and the right operator and ensure that the returns come back to the investor. So I think it's becoming more complex. And so intermediation will become necessary in the real estate investment world. It won't be easy to be direct. And just like you saw as an analogy or as a parallel in the stock markets, that the mutual funds came in and started, the good mutual fund managers would then start directing the investments into the right sectors or large cap or flexi cap. The same way in the real estate investment market, you will need good fund managers to be able to do that sort of allocation and take those bets.
So the PE pedigree obviously is going to matter quite a bit from the asset class perspective. Yes. Having the right partner.
Correct. Absolutely.
Sanjay, one of the biggest turnarounds story has been in the residential sector, has been the luxury homes during the pandemic. We've seen a lot of high net worth individuals in the country buy a lot of high-end apartments, villas across I would say the length and breadth of India. So the question is this asset class a lucrative market to invest in? Do you see players like Balaji getting into this market space? What's your take on that? I mean, purely from a luxury residential perspective.
No, it is a growing segment, Srini. And, if you look at how many billionaires get added every year in our country vis-a-vis what we've seen in the past, that will tell you the story. many of the corporates, if you look at the market cap of some of the big conglomerates, corporates, it's gone up. So you will see a lot more buyers moving into luxury over the next 5-10 years. And it's a huge market. However, luxury needs to be understood first. So, traditionally, we have done a very cosmetic approach to luxury, but honestly, luxury starts with the pin code or the location, the right, design product, and it's designed for specific audience in mind, and all the services and amenities that they want, and the serviceability. They are well traveled. They have high expectations, and they want the performance of the residential development at par with a 7-star luxury hotel, because that's what they are experiencing. 4 times a year, 5 times a year, if you combine their business travel along with the leisure travel. So I think there are stages of it, because we know there is a market for it. So if you look at, who would have thought that Bangalore will have a buyer for 30,000 rupees per square feet? It used to never cross 5,000 to 7,000 at one time. Mumbai is breaking its new benchmarks. We already at 1.5 lakh rupees per square feet. Nobody thought that you can achieve that kind of value in central Mumbai. For most people, South Mumbai before Haji Ali was the South Mumbai, not Worli and Lower Parel. But when you're designing product that you see in the Worli area for now, people have taken a call and they've moved, and they've experienced the quality of amenities, the network that they have, the social life they were able to witness during COVID particularly. It has really triggered a thought process. So I'm not saying that the old Carmichael and Malabar Hill properties will not retain their charm, but increasingly the definition of luxury has changed. We ourselves in Tata Housing doing 2 Haley's Road in Connaught Place, a residential development, which much before we even I've started getting calls for it. So I think it's a very strong segment, but at the same time, when you look at the project cost in key markets and prime locations, you're talking about land valuations close to 80-85% of the total project cost, can even be higher. So it's a slightly riskier game. It's a slightly niche game. And if you get that right, you will prosper, and the margins are good. In fact, entry and exit time is even better, because in luxury product, you don't have to do a finishing. Most people customize their homes. So you give them a shell and enter and exit fast, but it has very different fundamentals. Generally, they're likely to be high-rise structures. Low-rise villa developments will be there, but they will not be the true luxury that we're talking about. So I think it's the amenities and services which in most of the real estate segments we're alluding towards. What can we offer them in terms of experience? I think experience is luxury today, if you ask me.
So you're saying there is going to be a lot of interest from the PE players in the luxury segment as well?
I would say there'll be select, because luxury will not be a mass business, as you know. So I think they would be select who would value it as part of their portfolio. But I've yet to come across any development company which is strictly only luxury, or a fund only luxury, but that would be some time. You see that in mature markets like London, where the starting point is, 3 million pounds to begin with. Yeah.
So the pin code matters in London. So similarly, the pin code would matter in India.
Everywhere. Yeah.
Shali, how are we doing on time?
Yes, we are. Yeah.
You're okay on time?
Yes, we have 40 minutes to, still for the session.
Okay, good. So Gauri, life sciences, R&D centers, data centers, These are all turning out to be the new different asset classes. What's your take on this, and where do you think, what's the kind of investment that's going to come into these segments, these asset classes?
It's a very interesting question, particularly for some of us here in India, because generally these are requirements which we get to hear from the private equity community and investors from the more developed markets. The reason being, if you look at the last 10 years in terms of returns, I mean, because we don't have a proxy, we need to go back to the US markets for proxy returns. Specialty real estate, which is what you talked about, the data centers, the R&Ds, the life sciences, all of that coming into, and to a certain extent student housing, all of that comes under specialty real estate. Specialty real estate REITs have outperformed the traditional REITs by a margin of 100%. So the returns that specialty real estate has given us close to 13% versus 7% of a regular traditional REIT, which is commercial office space and single tenant office and multifamily. The reason again goes back to where the whole question of the risk and the arbitrage opportunities that are here. So why, and the industry actually has 50% of the REIT market today in terms of market cap is in these new age real estate. And back in 2000, I would say 2007, 2008, before GFC, it was only about 5%. So GFC sort of created the opportunity for these asset classes to sort of mushroom and grow. And the reason being, these are you're talking about what is the commonality in all these the R&Ds, the data centers, that all you talked about is the amount of capital that a tenant ends up spending. So there is a lot of stickiness to it. He's going to spend more than twice what you spend in terms of doing his own fit outs and putting in his own infrastructure and all of that. So that is number one. Number two, there is always a sensitivity to the location. So for a data center, there are only it has a lot of constraints. You have to have the cable landing stations. You'll have to have multiple telephone redundancy lines that should be available for you, and you should have those formats, sizes of land parcels. So all of that, and then there is the clustering effect as well. So if you look at it, all these asset classes are primarily asset classes which sort of goes back to that fill it, shut it, forget it kind of mode, where long-term leases, 10, 15, 20, 30-year kind of leases. And even if they are short-term leases, the capex that is involved from the tenant side is so huge that he's unlikely to vacate without suffering a huge penalty. So that's the reason why you have a lot of this taking off. And in India, I was in Singapore for our investors day, and a lot of met a handful of investors, and everybody is talking about what about life sciences, what about data centers. You go and tell them office, they are still office, work from home, people coming back. These questions always keep coming up, no matter what data points you show in India. They still they are all driven by the New York mentality. When they go to New York and they see that all the restaurants and bars are full, but the office is like I heard this anecdote. Yeah, I heard this anecdote about somebody, one of my colleagues was in the hotel and it looked into an office complex. Somebody was in the office and taking a selfie. So it has become such a novelty. So you go to the office and you're saying like, hey, you know what? And I'm on vacation. So it's like, I'm in the office, that sort of thing. So this is the asset class which will be of great interest. So I see in India, a lot more private capital is interested to look at India. And, we should thank the stars as well. It is not all of our own doing, and hopefully, like someone was telling that, if we can get the last mile sorted out, we'll be doing, and FICCI can help us a lot in representing our requirements to the government and ensuring that they do it. But there's a lot of capital, a lot of interest in India. All those that burned their hands, pre 2007, because they thought it like wild west, and then they realized the Indian business is probably among the sharpest. You just can't come and dictate terms and get away with it. that has changed. So, no, but this is going to be asset class. No, getting the capital into commercial real estate is still going to be a challenge because you need to really I mean, your counterpart you might convince, but he's going to have this 60-year-old board member who's sitting on the investment committee who gets who he gets to pitch for like 15 minutes in a month. It's very hard for him to change his perception. So, life sciences, data centers, anything that is new age. Is going to have much more traction in your ability to raise foreign capital as against your no matter how the performance of the traditional asset classes are going to be. So that is my take on how things are going to look over the next I think at least about next couple of years.
Interesting. And you stand corrected. It is fill it, operate it, and engage it.
And engage it.
That's going to be the motto for all of us. Sanjay, your crystal ball gaze into corporate real estate asset class for the next 24 to 36 months.
So our target for 2030 was 1.2 billion square feet, which I think we are on track. And as you know, we only capture, most IPC only capture the private developments. They don't capture the campuses, which a lot of IT companies own and develop, and some other Indian corporate houses who prefer buying assets. So I think that is sustainable. I think the competitive advantage is good. I think the talent pool is growing. I've increasingly seen talent being given higher responsibilities for bigger geographies outside of India. I see the concentration of global centers increasing. I see lately Indian banks, ICICI, Kotak, growing given the economy. I think new sectors or sectors like e-commerce adding to the office demand, commercial real estate, beside, of course, the flexi space and co-working, etc., which are new in addition to this. So overall, I think it's a very sustainable story. Our concentration risk at one time, which was on the IT sector, has been mitigated. Our office absorption in India is 45% dependent on IT. The rest all is on the other sectors, which is banking, financial, e-commerce, telecom, etc., etc. So it's a very diversified business. Gauri is right. There is, employees are shy or they don't want to commute 2-3 hours a day because they got used to sitting at home and managing the business affairs. It's going to take time, but you will, at least monitoring that we're doing at our parks, the absorption and coming back to office is increasing, which means if nothing is disrupted, I would be convinced that we'll have 50 to 70% office absorption or attendance in the office returning in the multinational segment. Indian corporates, by the way, 100% manpower is in office. It is just few multinationals who really pamper their talent a bit more and are redoing their fit outs just to appeal them or appease them. I think they will return by March. And if we are there by 70% and thereabout, things will change because productivity in office has been debated and settled. It is in favor of working from office and not working from home. And whatever news or relaxation that you hear right now on work from home, it's largely because of talent war, which is fair because the businesses have bounced. Most IT companies, Indian IT companies and foreign companies have recruited upwards of 100,000, 80,000 employees in a year, which was unheard of in the past. So all these data points actually directionally give us a lot of confidence that commercial real estate is here to stay. To earlier point, which Gauri was talking about, the appeal of the alternate segments, it is true, but it's also because office is very competitive, Srini. You already have a lot of players in it. Although with the exception of Hyderabad, we're not crossing excess supply right now because during COVID, many residential developers who were coming into office, they chose not to because now they're busy residential. So that speculative supply, which was expected in commercial, that has not come. And that's good news for the commercial sector in a way. So I think all arrows are pointing upwards, Srini, for me. As long as we, change the offering, and I've said it in the many forums that we will be a services organization in a real estate development business, and which is what Balaji and Gauri and everybody is talking about here, the service element of the business. And then we geared up for it. Thank you.
Interesting. Balaji, your crystal ball with respect to, from $27.8 billion investments that have come into Indian real estate, where do you think India is going to go from here? I mean, what's your take? I mean, indicative numbers, if you have anything.
I would take a more balanced approach because one, I agree wholeheartedly with Sanjay. I do believe the real estate sector would be one of the more attractive sectors in the spotlight for most investors, because it has shown its resilience. As I said, it is becoming a cornerstone for investments. So whether you do specialized real estate, office real estate, residential real estate, or service real estate, it will be attracting a lot of investments. So I would tend to believe we will be maybe slowly going into the higher single digits sort of a billions of dollars per year, what we will be able to get it. And hopefully one day we'll be able to touch $10 billion a year also easily. But on the other side, when I said I'll be a more balanced is, I think investments are always very global in nature. So when you're global and you have all this sort of a geopolitical uncertainty that Nija rightly pointed out, and you have this sort of a oil price spike, you have uncertain about the tightening of the liquidity in the global markets because of increasing interest rates, rising inflation. Overall investments swirling around would be lesser, because we have just come out of an era where liquidity was sloshing all around and was desperately seeking yield. Today, as soon as your dollar rates are rising, somebody will say he can just get into the GSEC market and sit tight in US, where he's getting a comfortable return, rather than take the volatility of a currency depreciation or coming across 10,000 miles to invest. So I would tend to believe that we have to be careful in the very short run, at least of next couple of years, that you might see these headwinds, that globally the liquidity which was there drying up slowly, and we having to compete to get that investment. So we need to be more competitive. That means we need to really figure out that our sectors are doing well, they are being able to give the returns, we are being fair and equitable to the investors, and not trying to shortchange them in any way. The developers are leaving enough on the table that everybody makes money. These are sort of important characteristics to remember. Otherwise, I think we will face headwinds in trying to attract the investments in the short run. But I would definitely know in the medium to long term, this will be one of the most attractive sectors for FDI or even for domestic investments.
Thank you, Balaji. Gauri, your crystal ball gaze into the future, overall, for the industry per se.
Yeah, I think, the industry is, matured quite well over the last, I'd say 15 years since 2008. Now, there's been a lot of learnings for the industry, and there's been a lot of consolidation, the listing of the REITs, and the amount of foreign capital that is coming in. A lot of not just LPs, but a lot of GPs have shown interest in coming into India to sort of showcase their skill sets and bringing new capital. A lot of private wealth managers from across the globe are trying to work with our own private wealth managers here in India to sort of get into this Indian market. So this all means that they understand the Indian, and they are at least accepting that India is important as a core market. They're also acknowledging that India is a difficult market for a newcomer. It is not, you cannot just land here, open an office and just because you have no proof of concept and you've delivered in other regions, India can mimic that. India has its own set of challenges. So one was sit outside and keep blaming all that is happening in India. The other nuanced approach is, yes, there is, because of the chaos that is there, You also have a lot of arbitrage opportunities that are here, and if you're able to identify those arbitrage opportunities, de-risk them, and work with good talented partners that are here who have the right value systems, there's a lot of money to be made. And it is only the start. I'm very gung-ho about Indian real estate, particularly because of what is all happening in around the world. So pretty much, Europe is definitely going through a recession. US will be having a very, very short recession. China, people are going to stay away. So all that capital that was allocated towards China has to now look at somewhere else. So it is, it is going to be India's, I would say India's decade is how I would put it. It is all on all our shoulders, the industry veterans that are here, that we do the right things and we make the right investments, and we provide the right returns to these new investors, so that we don't have a repeat of that 2007. All those who came in 2007 and disappeared in 2010 never looked back at India. So we hope we do. I hope we don't do it as an industry, and we sort of use this as a springboard to get India into that truly. We should stop being Asian. We were Asia. We became South Asia. We have to become India. Over the next decade. That's how I would put it.
Thank you so much, Gauri. Very, very nicely summarized. With words of caution from Balaji, loads of positivity from Sanjay, and of course the new slogan that we have formed, which is fill it, operate, and engage. Over to you, Shaili.
Thank you, Mr. Rao. Thank you, Mr. Rao, for moderating the session so well. Thank you, speakers, for sharing your views. This has been an enriching experience. The ideas and deliberations arising out of this conference would go a long way in addressing the challenges and reflecting a way forward. With these words, once again, I thank you all our speakers, delegates, and partners, especially Principal Partner, Tata Realty and Infrastructure Limited, and Mindspace, Associate Partner, Indospace, Knowledge Partners, Westian and Anurag, for making this event a great success. We will continue with our next panel discussion on fueling recovery for the real estate market. Forces will shape up the next decade of capital markets in the Indian real estate. Thank you so much.
Thank you, guys.
Thank you. Thank you.
Sanjay, happy Diwali, guys.
Happy Diwali.
Thank you. Same to you.
Bye.
Thanks.
Shobit is all dressed up. We should at least get a jacket.
Yeah, I'm just going to pick up mine.
Yeah. Shobit, you're putting us to shame.
I can take my tie off. I have zero problem. I thought it's FICCI. It'll be a formal event, so I said, okay, chalo.
No, I want to wear because my room is actually very cold right now.
Yes, ma'am.
All right. Good afternoon and a very warm welcome to FICCI's first edition of Real Estate Investment Summit, Building the Next Generation India Real Estate. Now, delegates, you've already been with us for a very engaging session on real estate investments in India, the rising asset classes, just before this one. And now we move on to an equally interesting panel discussion too, which is fueling recovery of real estate market, which is themed on forces will shape up the next decade of capital markets in the Indian real estate. We will hear from experts as to how the next decades of capital market will look like for the Indian real estate here. And to bring alive the discussions, we have amongst us a very seasoned experts. We have Mr. Sharad Gohil, Managing Director, Fund and Asset Management, Indospace. Mr. Sharad Mittal, Executive Director, Real Estate, Motilal Oswal Alternative Investment Advisors. Mr. Amit Dhawan, Senior Managing Director and Country Head, Heinz India. The session will be moderated by Mr. Shobit Agarwal, MD and CEO, Anarock Capital. Shobit is a veteran with FICCI and has been working with us for quite some time. And his amazing ability to bring about his own knowledge and integrate with what he will be able to take out from our esteemed panelists is worth watching. I invite Shobit to please take the session on from here. Shobit, over to you.
Thank you, Nirja. Thank you, FICCI. We are all speaking on behalf of my fellow panelists. We are very thankful for giving us this opportunity. It's the first session of a first edition of FICCI on real estate. So I'm delighted we are getting some spotlight. Thank you, Amit. Thank you, Sharad, and Sharad again for joining us. It's an afternoon session just before lunch. Hopefully people will not get to sleep. We'll try and finish and not keep them from lunch. It's a very interesting session. I saw the subject, fueling recovery for the next gen. I think it's probably the right time. Residential is going through the roof. There's an upswing after COVID. Sharad, for you, warehousing has probably benefited from all the COVID. During COVID and after COVID, it continues to gain momentum. And Amit, I'm going to use your skills either on the credit side or offices, because that's what Heinz is more known for. I'm very, very happy and pleased to note that you've finally taken a step to come into Bombay. Let me just start by asking you, what took you guys so long? You built a beautiful asset in Delhi. It's outperformed everything else in that market. Marquee names, you've managed it really well. What took you guys so long to decide on coming to Bombay? And now that you're coming in, what's your plans?
Thank you, Shobit. Thank you, Anarock and FICCI. Before I start, let me thank you for this opportunity. So, Shobit, if it was out of choice, your question would have been valid. But the reality is it was not out of choice. I would have loved to be in Bombay 10 years ago. It's a difficult market for a new entrant. Land prices are really high. Therefore, this traditional model of buy land and then build and make a multiple on it doesn't really work. A lot of the financing of land in Bombay has been done through debt just to spice up the equity multiples, to get in, which traditionally we don't do. We don't fund land through debt. On the other hand, getting access to a clean title, well-located land parcel, there are at least 10 developers who are locally present, strong and well capitalized. So by the time opportunities used to reach us, they were in most cases the ones that have been rejected by the local developers. So I have to say it's been a tough market for us to enter, but we are delighted that our 12th project is now in Mumbai. We've got 11 others now in NCR, Bangalore and Pune. So definitely scaling up, and the plans for Mumbai are big. If we are able to get our way, I would love to shift our headquarters from Gurgaon to Bombay. It hurts that I don't meet all of you guys more often. So we're very happy to be in Bombay and would definitely grow from here.
I'm super delighted to hear that, and we'd love to have you in Bombay. Although, let me tell you, for most of us, there's one reason to go to Delhi, is to meet up with you in your super nice
You are
office.
most welcome. I won't move my family to Bombay next year.
But just speaking, I picked up a lot of things from what you said. But recently, I met a Japanese investor. They have bought land, clean title from the government, paid top dollars for it. It's broken all records. Roughly 1,000 crores an acre. And they did it once. We thought it was a mistake. And they did it again. And we went and we had the opportunity to meet them and said, what are you guys thinking? They said, look, we love the market. We've done studies on 10 different markets and chosen Mumbai office over everything else. So from Tokyo, they're coming in directly to Mumbai and looking at all the infra growth under execution. Their response was, and I'm going to I'll bring you in saying, you guys don't seem to know your future. We can see it coming with so much infra. Your prices on commercials are going to go through the roof. And so also demand. So it's not that prices will outpace the demand. They said the demand will also be there. And also the infra, the second airport, the sea bridges, the coastal roads. And they said, look, whenever we come in, we see progress. That gave us the confidence. And they're fully funded land, equity, no debt. They're saying, don't worry, we'll manage. And in fact, they were surprised with the cost of construction. They said it's very low. So we're going to be 1.5, 1.6 times the cost. So they've overpaid for the land. Or we think they've overpaid. They don't think so. And they want to overbuild as well. So you're going to have competition. What do you think about it?
No, I think it's actually fantastic that we have players like Sumitomo in India. I think there are several reasons why I actually believe what they did was good for them. So number one, their access to capital is at much lower, expected returns than we have access to. And straight away that, is an arbitrage on how much they can pay for land and how much they can construct for. Second, I completely agree that this is the place to be. I mean, right now, if you're a global investor, you are scared of what's happening in the US, you're scared of what's happening in Europe. You're also worried about the self-goals that China has committed, self-goals that Russia has committed. Brazil is at 14% interest rates today. So the investable markets today are Japan, Australia, and India. I mean, from a developing market perspective, I have never in my working career seen so much interest in India, and definitely more than China. It's just never happened. So that's number two. And number three, you talked about One Horizon Center very briefly in your opening remarks. We sold that asset at $300 a foot. That was the GAV. It is extremely low by international benchmarks. So now when you've got the world's fifth largest economy growing at 7% per annum, and you've got the financial capital Mumbai, and within that you've got BKC, right? And you've got land which is only a few $100s a square foot. It's attractive for them. We have a very strong opinion as well that once India migrates to a core market, and right now it's still not classified as a core market for, let's say, the German open-ended funds and so on. Once it gets classified and re-rated as a core market, is when your cap rates will significantly start falling from the current levels. So they've gone from where, I think the early entrants would have acquired office assets at about 11% cap rates to now roughly, let's call it 8, give or take. Yeah. But there is no doubt in my mind that with inflation under control post this current couple of years, and with India getting re-rated as a core market, these may go down to 5%, 4%. It's definitely achievable in the medium to long term. So anybody who's able to come in, buy land, build a high quality asset, hold it for, and Sumitomo's got deep pockets. They can hold it for a really long period of time. I think they'll witness, escalation in values, that we can't, really underwrite. I can't underwrite them with my source of capital and, underwriting period, but Sumitomo can.
Yeah. We asked them one question, and you're absolutely right, Amit, and we were surprised. They were doing some capitalization, and we said, but how will you take your money out? And they looked at us saying, what do you mean you take money out? He's saying, we're here for 80 years. We're not taking anything out. So he's saying, we don't care about the structure. because we are very clear that we're going in for 80. So we said, are you sure it's 80, not 30? He said, yes, 80 years. We have never sold asset. They never sell commercial assets around the world. But anyways, on all the positive things that you've said, Sharad, you've raised a lot of, Sharad Goel, you've raised a lot of money. Your firm is sort of headquartered out of Singapore. You deal with investors every day. Do you resound what Amit is saying, that there is tremendous interest from global investors and India is the spotlight, or India is on spotlight at the moment for the various reasons that Amit mentioned?
Yeah, absolutely.
What's your view on this?
Thank you, Shobit. And I echo everything Amit said at the beginning, actually. It's a pleasure to be here on the panel today with such esteemed co-panelists. And Amit really hit the nail on the head on a couple of fronts, actually, when he was very eloquently articulating how India is perceived from the West. I think, Shobit, you're absolutely right that the interest in investing in India is hitting some very unprecedented levels. And there's two major reasons for that. I think first and foremost, yes, you see the rest of the world suffering as we come out of this pandemic for the last couple of years. But you just need to look at where India's growth trajectory is, relatively speaking, and how it compares to other more westernized markets, but more importantly, compared to other emerging markets. And when investors are looking at opportunities to place their capital, India over the long term outweighs. There's a lot more benefits that investors can see. So I think the interest has remained very, very strong. India itself has done a lot to open up, as you know, to attract more foreign institutional capital to the market. We're seeing that as a business. We're now on our fourth fundraise, development fundraise, where we're targeting $600 million in a sector that's still relatively nascent. Right, when I sit here with Amit and Sharad on the other hand, and you know, we've all worked in different real estate asset classes, but warehousing and industrial logistics is still very much at its nascent stage. It didn't have the head start that offices and maybe retail did when that first wave of private equity came into the market back in 2005, 2006, when FDI really opened up. We have the benefit of being the first mover advantage. So today we sit with a portfolio of over 55 million square feet. We have over 23 million square feet that's operational. And it's a long way ahead that we see, as you mentioned earlier on, the growth trajectory, the consumption demand is astonishing. And, you know, I think Amit mentioned this earlier on, or you may have mentioned it, that you don't know how much future growth potential India actually has, is what the Japanese investor had said. And it's a very similar message that we get from GLP, who's our largest shareholder in the business. And their view is you can never build enough in a country like India. And I completely echo that. So we plan speculatively. Right now, I think in terms of e-commerce and manufacturing, these are significantly paving the way for demand, or unprecedented demand, that this economy has not seen before, specifically in the sector that we operate in.
Thank you. Thanks, Sharad. And I feel in the same way that, you know, from whatever we are hearing from investors, India is in a good spot. And I think next year will be for India. I'm talking from a financial year perspective. I think there's going to be good commitments made after a very long pause. And that long pause was largely coming in from Resi. I think the office and industrial was doing well. Let me bring in Sharad on the opposite end of the poll stick. So we met the other Sharad, or he's talking about how much money he's raising. And that's the sector, in my view, that's overcapitalized. So they don't have a problem of cash or money, right? If there's enough and more available, they have a problem of the product, that there's not enough land supply. But in Resi, although the demand is up, Sharad, there is still a huge dearth of capital, and you are at a good spot. You can sort of underwrite resi. There isn't much competition from investment managers around the world because they are all busy doing offices and warehouses. And before I ask you anything about resi, I want to ask you one thing, right? I've never heard equity market people saying nice things about resi. Your full house is just equity market guys. How you doing resi? And they're willing to put their balance sheet money, but they never come on TV and say anything nice about real estate. So what is it? How did you convince them to go so deep and so consistently putting and contributing? I think it's huge canvassing that's required inside, which can only come in from conviction. So Sharad, over to you.
Thank you.
What is Motilal Oswal thinking? And they're putting money. You've raised, I think, a new fund. Let's hear from you on this.
Yeah. So Shobit, thank you. And thank you everyone for having me. So as far as Motilal Oswal as a firm is concerned, it's deep into equity markets. If you come into our building, every piece of it, there you will get a sign of people breathing and talking about equity markets. One of the businesses that they kind of started 16 years back was third-party fund management. And that's where they manage large amount of money in public markets and sector agnostic private equity. I joined 10 years back with an idea and an extension of the private equity business, real estate. And I think the markets were tough and we have taken smaller steps. Now we have raised 5 funds. We are launching our 6th fund. I think the firm has really supported the team on the way they have gone about building up the business. As far as the residential markets are concerned, not only me, now also the firm, one of the key founders in the firm is Ramdev Agrawal, who's very well regarded in capital markets, has been very vocally saying that he had a problem with the way the business was being done. The firm never questioned the size and scale and the opportunity set in the residential market. It's just that the way the business was approached, the kind of operator, the developers we had, or the way the businesses practices were there, all of them have gone under correction between 2014 to 20 at the back of number of reforms which has taken place. And I keep giving an example that it's only the 22 months that mattered. When the demonetization happened in November 16 to ILFS going down in August 18. In that 22 months, everything got packed. We were in the thick of action, so we probably don't take notice of like that. But in those 22 months, everything got packed. And I am really optimistic about the way the sector residential market is looking like. Amit and Sharad was talking about office and the warehousing. Real estate, residential, we are just scratching the top. It's with all this noise that the residential is back with a bang. We are going to sell 300,000 units across 8 cities, totaling to 3 lakh crore, little over that. Our GDP will be 3 trillion, will be little over 1%. The primary sales will be little over 1%. 2011, we did 400,000 units at the back of Noida's run, but we still, 11 years back, the income levels have gone up. I think we are in for a good, sustainable residential growth. I'm hoping, and I feel quite confident, it will not be speculative. One of the key things is that it's a consumer product. You want stability in the market. You don't want boom bust cycles. And with the RERA coming in and with the developers getting consolidated, I'm extremely hopeful. One challenge that you mentioned, where is the money? Where is the capital going to come from? Where is the capital going to come from? Look, regulators in India have divided this residential or real estate into 2 parts: pre-approval and post-approval. No amount of large institutional money, specifically banks and NBFCs in form of debt, can come pre-approval. And that regulation came way back in 2007, just before the GFC happened. Large part of risk capital requires at that stage. Once approvals are done, there is enough and more capital will be there. You are aware, we know that some of the banks which have been little quiet on doing construction finance are gearing up to build large books. Some of the large banks in India, and they will take that pole position. Maybe it'll take a couple of years for them to get the things in place. But I think post-approval construction finance will be largely sorted. It'll happen at rates which will work well for the developers. The challenge is, what do we do with pre-approval part for buying land, for getting approvals, priming up the site, bit of a marketing, and that's where I think there is complete paucity of capital. I think as the consolidation happens, the source, you need equity kind of money, you need long-term money. I think there will be three things that will happen. One, there will be more attraction of going public. The way people have seen success of some of the developers, specifically I'll take, say, Lodha as an example. The story completely turned around at the back of very successful IPO. You have equity money on the tap. I think we will see more and more larger developers tapping capital markets. Second, I've been seeing some trends of some of the developers raising AIF, local capital. I don't see that going very deep, but some of them would be able to do that. Third, I think there will be platforms, and you are better judged than me on that. I think people will take notice. I'm talking about global capital. And look at the way they have gone about educating the commercial real estate developers. You look at most of the commercial real estate developers, their balance sheet is healthy. And I would give credit to their institutional investors, which came 10 years back, and they've put best practices. I'm hoping something like that could also happen in residential. Should happen sooner than later is my view. And then there are players like us who will continue to raise domestic or international capital and continue to support. But overall, the debt-like structure, what Amit mentioned, that at a land stage where there is uncertainties involved, wherein there is a lot of debt money that has gone in, would move towards more quasi-debt or quasi-equity before it transitions completely to equity. And I think that's the journey that we are going to do over a period of next 3 to 4 years.
Absolutely, Sharad. I mean, I think you said a lot in the 5 minutes that reforms have happened, consolidation has taken place, growth is happening, is visible, and we are still to catch up with our 2011 peak. So we have proved that we can go up to 400,000 apartments sales in 2011. Why not do it again? Yeah. So we have a long runway on residential. Amit, I'm going to bounce back at you. I mentioned I'd talk more about offices, but I think on this point, I want to saying, would Hines start to look at doing or investing in residential real estate in India?
Absolutely, yes. And we're already doing it. So just as context, Hines has done mostly office projects in India. And that's why the perception is that we're an office developer. But we've got 130 million square feet of warehousing and industrial development as well, and 70 million square feet of residential, and 35 million square feet of retail. So in the fullness of time, all these property types we will do in India as well, all 4 of them. I see opportunity in each of the 4. The question for us has always been, we should walk before we try to run. And it's been a journey of a lot of learning. It's been patience. And I think I would say that today the portfolio is 8 office projects and 4 residential. We're present in Resi in NCR, Mumbai, and Bangalore. In fact, in Resi in Gurgaon, we've got 2 projects under development, 2 term sheeted, and 1 or 2 more under advanced stage of negotiations. So NCR Resi is kind of on the way and flying. We're looking for, land and partners in Bangalore and Mumbai, which you and I have spoken about once, but I will, knock your doors again on. And I think the clarity with which Sharad said, and Sharad, firstly, congratulations on this platform to you. What you've achieved in terms of your track record is the reason why the group and the world is backing you. The statistics that I hear from Sharad Mittal on how many exits they have done and at what returns is mind-boggling. And I think it's a really good sign for Indian real estate that somebody is able to achieve that. And we certainly are believers ourselves in the Resi sector and warehousing. If you underwrite well and you can execute well. See, the problem in India has never been opportunity. It's been, can you make use of the opportunity? Can you execute well? And Indospace has done a remarkable job of executing in their space, and Sharad in his space. So I think the short answer again is yes, we will do more Resi. We're already doing more Resi in Gurgaon, and it will expand in the rest of the country. We've got, by the way, a project that is in due diligence and documentation in Powai as well. So it's coming.
But I'm so glad to note. I purposely asked that question, but I think the agenda or the point that we're trying to make here is Sharad has paved the way to say, look, you can make money in real estate, residential real estate. Reforms have come in, consolidation has happened, and you coming in post RERA, post GST is an absolute outcome of this structural shift that's happened in residential, and you're absolutely leading the pack on the resi side from a global perspective. I hope you make money on these assets, which means more money will come in. So fingers crossed, you know who's praying really hard for you guys to make money, and I hope you will do that. Sharad, I'm going to come back to you. I know there's one subject that we have to cover, which is tier 2, tier 3 towns. I think offices for now are still stuck with tier 1. Resi is probably moving to tier 2 slightly, which is capital cities. But I think a warehouse can lead the way into tier 3 cities as well, because these are very large consumption centers. And I want to know your thoughts, saying, are you going to look beyond the 7 or 8 cities? And how many more cities do you want to go in? What's the thesis?
Sure. But so look, I think, as you know, and you quite rightly pointed out, we've been predominantly focused on the tier 1 or the top 8 markets in India over our 15-year period. We have ventured out into certain tier 2 markets historically and more recently. I completely agree with you. I think the demand has actually never been in question. And I think e-commerce has now helped catapult that level or quantum of demand that we're seeing in some of the peripheral locations, and certainly tier 2. Tier 3, for both of those strategies, is something we are considering. The question has always been about scale. And to be able to lift and shift the infrastructure and the resources, for example, that any organization would invest in scaling up certain smaller markets, that was really the challenge. And then you also have the rental market as well, and whether or not rents are deep enough and potentially strong enough to justify the economics of going. Because what we've seen in certain tier 2 markets, Shobit, is that the land costs are, if not the same as some of the top 8 markets, but the rental values are not quite there. So the economics historically did put us off. So I think that when we look at, there's a lot for us to do in the top 8. We are looking at another 15 markets outside the top 8. It will most likely be tenant-led, and we are exploring that with a number of current customers who have that significant pan-India reach. And I think, again, it's going to be largely driven by e-commerce from what we're seeing, not so much on the manufacturing side. I think there's a lot of people that want to tap into and have access to the customers that are operating in some of these smaller, and I say smaller, they're not smaller, they're the size of some other countries, in terms of population, and consumer spending is at an all-time high. People have now access to digital spending, and they need things quickly. So an Amazon, a Reliance has to be closer to the source, and so it's something that we will ultimately follow. We are taking our time at it because the economics also have to justify it.
It's absolutely well said, Sharad. We do a lot of leasing on the warehouse side. We have now earned fee from Varanasi, we've earned fee from Indore, Jabalpur. These are cities that we didn't have coverage on. Our tenants have forced us to go find spaces. I think once they pave the way, you will follow. But 8 to 15 in tier 2 cities in itself, you're doubling down. So there is headroom, like you said. Hopefully they'll come. I've got 5 more minutes. I'm going to move to 2 different products, one for offices, Amit, and one for Resi. And this is to do with new age real estate products, which is co-working, and Sharad, for you, co-living or rental housing. What do you guys think, starting Amit saying, co-working is probably a little bit more advanced. Do you think there is more depth and more acceptance? And will it continue to coexist with the actual office demand How do you see co-working playing out, Amit? And then I'll move to Sharad on co-living and rental housing. What's going on there?
Certainly, Shobit. I think co-working used to be a term that was aptly describing the phenomenon pre-COVID. I think I would call it serviced offices or managed offices a lot more now, because the solutions they're providing is not so much co-working, but more enterprise solutions, even to large occupiers, blue chip from Silicon Valley. And I think the trend will continue. We certainly think that the managed and services office would be here to stay. At least 20 to 30% of the total demand could end up being, flexible and serviced and managed in that manner. And the reason is, everybody was a generalist earlier, and we're moving to an age of specialization. So as a developer, I was supposed to know land and approvals and design and construction and financing. You needed the full scope. And as an occupier in India, I needed to identify the opportunity or good buildings. I needed to do the fit out myself. I needed to do management of my facilities myself. But that's not where the core competence is. So for an occupier who's able to save the time and energy to select good locations and buildings, save the time to negotiate with a variety of counterparties, save the time and money to do the fit outs themselves and to do the management of the offices themselves, they can rather focus on their core business and outsource management of their office to a third party. And that's exactly what the enterprise solutions brings to the table. So I think it's here to stay, and it'll probably grow in force irrespective of market cycles from here onwards.
A very good perspective, Amit, saying that these are cost efficiencies that are coming in and management bandwidth being freed up.
Absolutely.
And both of these are permanent advantages. So they're not affected by COVID or not COVID. This is going to continue to stay and grow. On that note, Sharad, what do you think about co-living or stroke rental housing? Because whatever we are building, and you mentioned it, and I sort of supported 300,000 units, are all for sale. What about rental markets? Not everybody can afford to buy what we are building. So what happens to people like that? And globally, it is a very well accepted,
very large asset class.
Very large asset class.
So Shobit, if you look at co-living in India, I'll divide it into two parts. I would say student housing is when it's kind of started as, and second is the young professionals. India is a country where migration is taking place. People are going and working largely in service industry led by IT. And there is a need for having rental housing in a more organized way. Fundamental challenge is the way the real estate has given returns over a long period of time. A very small part comes from the rental yield. A large part comes from the capital gain. So if you look back, say last decade was a kind of a lost decade, but if you look at over a long period of time, 20, 30 years, the capital appreciation forms almost 80, 90% of the total return. And the rental yield is low. So my sense here is that if rental housing business, the revenues or the profits are largely going to come into the services which are thrown in along with the hard asset, it will remain to struggle. If my rental yield is between 2 to 3%, best case, and my cost of capital is bare minimum 6-7%, you need very deep pocketed, long-term, hopefully Japanese investor and taking a 80-year view on the Indian markets. But I think that's the core challenge. Globally, wherever there are rental housing, there is a parity between the yields and the cost of capital. I think we are some time away from that. Yeah, social housing is something which probably, when you are saying people cannot really afford, and there is, I think then there is a role of the regulator or the government to have certain policies to support that. Social housing is different than running it as a business. Student housing also, I've typically seen the frugality at which the Indian student studies is not. I always thought young professionals, IT professionals in some of these cities, which is also a floating population, could be an opportunity. I think it boils down to the way the maths of the business doesn't really stack up well.
Absolutely. Guys, I would love to go on and on. I think all very interesting comments and observations. Obviously, they come from deep experience that you guys have had and very successfully run your own businesses. We are obviously short of time. I was told 12:45. We've kind of exceeded it. So I'd like to thank you guys very much. All I've taken away from here is that the market is re-rating itself on resi. There's large potential on offices. Tier 2 towns and tier 1 will continue on warehousing. And guys, co-working and perhaps social housing is on the cards, right? So that's the long and short of this. Thank you, Nija, and thank you all my fellow panelists for sort of
Thank you, Shobit.
taking on this time. Thank you so much.
Thank you. Thank you. Everyone.
Thank you, Shobit.
Thank you.
Thanks, Amit. Thanks, Sharad.
Thank you, Mr. Agarwal, for moderating the session so well. Thank you, speakers, for sharing your views. With this, we have come to an end of today's conference. I would like to thank our partners, especially principal partners, Tata Realty and Infrastructure and Mindspace, associate partner, Indospace, knowledge partners, Western and Anirog, for making this event a great success. I would also like to thank delegates for taking out their time to join us today. Thank you and wish you all a very happy and prosperous Diwali.
Thank you.
Thank you, everyone.
Thank you, Shelly. Happy Diwali, everyone.
Bye.
Bye. Thank you.